tell us about how difficult this is getting for pension funds. There was a time when they could find at least some yield, right? Is it now becoming a situation where it's really difficult to find anything?
Yeah, that's definitely the case, and this is a great story from Bloomberg's Mortgagebacked over in London, who wrote this. So I think, the important thing to think of here is obviously the risk-free yield globally has gone down materially. You can either, extend into less liquid asset classes or take on more credit risk. But for a lot of these funds, pension funds, insurance funds, in fact, in a lot of cases, their buying activity is helping cause the dynamic they're most worried about. Back in 2015, a trio of researchers, which include Yun-Song Chin, who's now head of the BIS, chief economist there, they essentially wrote how, because of asset liability and duration matching among these big funds, when yields go down, they will become bigger and bigger buyers. So you kind of that negative convexity argument you hear a lot with mortgage-backed securities. This is also something that influences yields at the longer end when pension funds are getting more and more involved.
Do they have to change their mandate or their charter to be able to do this?
So there's a couple things you can do, right? There's options. You can either, change your return assumptions. A lot of funds are doing that. Or you can change what you're willing to pay out at the end. That's obviously a much a trickier sell and a more contentious idea here. But wrapped in this question is actually where people see a lot of support for markets. Brian Reynolds, he's a strategist who recently opened his own research shop. What he's been going on and on about is how pension funds and their allocations and their need to add more and more to either riskier assets or to take more to then invest in the market. This is a big structural support for risk assets. It's a big support for credit in particular, big support for debt-funded buybacks, and how this kind of dynamic is actually, helping to perpetuate what we're seeing in terms of the long-standing risk rally.
What are some of the biggest pension funds that have been doing more and more of this?
So Brian's got an amazing list. He's been tracking this essentially since 2009, and it really is across the board. You do see more votes to essentially increase credit allocation, increase allocation to alternatives or more illiquid assets, and in certain places that illiquidity is a virtue because you don't have to necessarily mark to market as frequently in the face of a downturn.